The divergence between gold and oil prices. What it means for inflation. Over the past couple of years, we've seen gold hit record highs, while oil prices have remained relatively stable. This contrast reflects a complex interplay of economic, geopolitical, and market-specific factors. Let's break it down. Why is gold surging? Gold has always been a symbol of stability in uncertain times, and today, its appeal is stronger than ever. 1. Geopolitical and trade uncertainty. We are living in a world of heightened tensions. From trade wars to military conflicts, investors are looking for safe haven assets. President Trump's recent 25% tariffs on steel, aluminum, and other imports have reignited fears of global trade disruptions. Meanwhile, ongoing geopolitical crises, whether in Ukraine, the Middle East, or elsewhere, have added to market instability. The result? A rush to gold as a hedge against systemic risks. 2. Central banks are buying gold aggressively. Nations across the globe are making strategic moves. Central banks in China, Russia, India, and Poland are accumulating gold at record levels, over 1,000 metric tons annually since 2022. China alone accounted for 43% of central bank purchases in late 2024. Why? Because they are reducing their dependence on the US dollar and preparing for potential economic uncertainties. 3. Structural demand and speculative momentum. Gold isn't just being bought by governments, it's also a hot commodity for investors. Financial analysts predict that gold could surpass $3,000 per ounce in 2025, driven by both institutional buying and speculative interest. The demand for gold isn't just about security, it's also about profit. Why isn't oil rising at the same pace? While gold is soaring, oil remains relatively steady. Why? 1. A balanced supply and demand equation. Oil production is keeping up with demand. In 2025, global supply is expected to rise by 1.8 million barrels per day, thanks to increased production from non-OPEC Plus nations like the US, Brazil, and Guyana. Even with OPEC Plus managing output, US shale production and resilient Russian exports have prevented major price spikes. 2. Mixed demand signals. While global oil demand is still growing, expected to rise by 1.05 million barrels per day this year, it's not as strong as expected. Weaker than anticipated consumption in China, India, and Saudi Arabia has dampened the bullish outlook on oil prices. 3. The push toward renewables. The world is changing. The rise of renewable energy and electric vehicles is shifting long-term demand away from oil. Unlike gold, which has always held its value over time, oil is facing structural risks as economies transition to cleaner energy sources. What does this mean for inflation? The divergence between gold and oil prices tells us something important about inflation. Gold's rise suggests that investors are bracing for inflation. They fear currency devaluation, the inflationary effects of tariffs, and the impact of rising fiscal deficits, especially in the US, where debt to GDP levels are a growing concern. Oil stability, on the other hand, suggests that energy-driven inflation is under control. Unlike the oil shocks of the 1970s, today's market is well supplied, preventing runaway price increases. Conclusion: a climate of fear, not a crisis. So, what does all of this mean? Investors are preparing for inflation, but we are not necessarily in an inflationary crisis. Gold's surge reflects fear of geopolitical instability, fiscal uncertainty, and policy risks. Meanwhile, oil stability suggests that, at least for now, the real-world inflationary pressures remain contained. This is a moment of transition, one where caution dominates markets, but fundamentals remain balanced. How this plays out will depend on policy decisions, economic trends, and global stability in the months and years ahead.